Hey, Jason here. Today's video, we're not doing a normal kind of quote-unquote stock analysis video of a new stock. We're doing a case study of my first ever 10-bagger stock. Just happened, I just found out about this last week. Stock is up more than 10x since I bought it and recommended it in portfolios I manage. And I'm going to do a case study of it today to help you figure out how to spot potential 10-bagger stock criteria or traits. Sorry. Before I get to that, though, I'd let you know you can get this here as a podcast anywhere in the world for free on all major podcasting platforms: Stitcher, Anchor, SoundCloud, Spotify, iTunes, and more. This is part of the I Love Dying Listing podcast anywhere in the world for free. If you like this video and our other videos, make sure to subscribe on YouTube and hit the notification bell so you know every time we release a video. We're releasing videos all the time. Okay, so normally I go through these long disclaimers, all the things. I'm not going to talk about the short selling and stuff that I don't do here because I own stock in this. So this is the disclaimer today. I own stock in the company we're going to talk about. I have owned stock in this company, BESY Semiconductors, since October 2015 in the portfolios I manage. Still own it to this day. My first ever 10-bagger stock. This is for informational purposes only, though. I'm going to show you, since I recommended it in October 29th, 2015, it's up 1,209%, so it's actually a 12-bagger. These recommendations that I'm going to go through here aren't going to guarantee you're going to find a 10-bagger stock, but they will increase your odds of doing so. Again, this is for your informational purposes only. This is not investment advice, but this is to help you kind of spot traits from a 10-bagger stock, real world 10-bagger stock. Okay, so let's get to display number 2. Okay, so what you're seeing over here is the article I wrote. This is an investment newsletter I started back in 2014, I think it was, maybe early 2015. It wasn't very popular. So if you have seen this, thank you, first of all. But you're probably rare. Most people have not seen this. But this is an article I wrote in October 2015 for subscribers of this paid, what then was a paid newsletter. Again, I don't do it anymore, but this was one of the articles. The title of the article: Next GE pays you a 10% dividend now, while we earn another 35.4% in the next year. It's a pretty bold statement, especially for the next GE, correct? I talked about this a little bit in the preview video, where I showed the chart of this company being up 1,209%. I'll probably show that again later. But why did I call it the next GE? Why would I do that? Anybody who follows my stuff, if you follow my stuff for a while, you know I'm not hyperbolic. Why did I call it the next GE? Because specifically in there, and this is story of Jack Welch and him running GE in the 1980s, and his famous saying was we're either going to be first or second in every single business category, or we're going to sell it, or we're going to sell the business category, or we're going to cut the business. The reason I called this the next GE was for 2 reasons. BE Semiconductor said, pretty much the same thing. They're either going to be first or second. I can't find it in here. Maybe we'll find it when we get to the annual report up here. But they said essentially the same thing. We're either going to be first or second in every category, or we're going to sell it, or we're going to cut it. Now, does that mean they're going to become the next GE? No. Another reason I call it the next GE is because their margins are spectacular, and they dominated the areas that they were in at that point in 2015. Okay, I'm scrolling through here. This is story stuff. Okay, this is important. Investing in picks and shovels. These are some of my favorite kind of stocks. Picks and shovels plays is what they're called. Picks and shovels plays. This goes back to the story here that is outlined in this quote by Peter Lynch back in the 1840s, 1849 gold rush in the U.S. A lot of people went to San Francisco area and California to find gold because there was a huge gold rush and people found some small amounts of gold. So a lot of people traveled west, from the east in the U.S. to try to find gold and make their fortune. The people who made the most money, though, most of those people became destitute. Some lost their lives through suicide, drugs, addictions, all that kind of stuff. Very few people actually made a ton of money on gold. The people who made the most money consistently were the so-called picks and shovels play, or the people that sold things like picks, shovels, Levi Strauss in this case, blue jeans, things that were absolutely 100% necessary to dig for gold. In the Levi Strauss case, jeans, they were durable to hold up to the elements and the rocks and the mud and stuff like that. Picks and shovels, tents, you need those kind of things to dig for the gold and to survive. So anytime a company is a picks and shovels play, that gets me interested off the bat. So what does that have to do with today's company? Let me switch to the other screen and show you their company profile on Morningstar. BESY Semiconductor Industries NV is a Netherlands-based company that manufactures and distributes semiconductor assembly equipment for semiconductor electronics, mobile internet, computer, automobile, industrial, and solar energy markets. Firm's products are broadly organized in three lines: die attachment systems, packaging, which includes molding, trim, and form, and singulation systems and plating systems, primarily for the electronics market. Okay, what does that mean? That means they produce things like, let's say, plastic molds and packaging for the semiconductor and microelectronic industry. That is a picks and shovels play because you have to package these things up. It's necessary for those same reasons. And it also means that with semiconductors going into more and more things every single day, even back in 2015, and that's exploded further now, and it will continue to explode with the Internet of Things that we're still kind of just in the infancy of. This will become necessary for everything. That's why it's a picks and shovels play. That's one of the main reasons I loved this stock back in 2015. Bigger reasons you'll see here in the key ratios tab. Okay, so 2015, so it's actually probably these numbers, because 2015, this is the full year numbers, and I was analyzing them in October 2015, so I did not have the full year number. So it was these numbers that I was going off. Again, if you've seen my other analysis, you know what I'm going to talk about here. Operating margins, fantastic. They had a huge increase in operating margins, though. So from 19 million in 2013, 72 million in 2014. So what I did in the analysis, which we'll see over here back on the other page, is I fixed the valuation. I didn't fix the valuation. What is what I'm looking for? I annualized the valuation. So normally when I do a valuation, for example, it's say 8 times trailing 12 month, in that case, $72 million operating profit, plus cash minus debt, blah, 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 blah. What I did in this case is I took the average. So I made sure I had a margin of safety. We'll get to that more shortly, but I'm going to go over briefly what I saw then is why I loved it. Rising book value per share, rising free cash flow, huge ROICs, again, huge rises. So what I say in all of these analysis videos, if you see my other analysis videos, is I look for ROICs above 10% on a consistent basis. This is not consistent. This is one huge jump. So why did I still invest in this company? We'll get to that, more reasons later. Huge free cash flow, again, huge spike though from 2013 to 2014. From 2.5% to 15.2%. So, and then it's just absurd now. It's gotten even higher on all these metrics. The metrics have continued to explode. just checking over ROIC, operating profits. Operating profits have continued to explode from 19% when I bought to 40.5%, which is insane. I look for anything with 10% on a consistent basis. Okay. They had little debt at that time. They have more now, but they're also more profitable now, so that's something we can talk about later. But that's what I saw then, is they had a ton or little debt compared to a ton of cash as well. Added more margin of safety. And again, we'll get to the actual specifics, what I talked about in the article here in a minute. Huge decrease in the cash conversion cycle, which improves efficiencies, which improves margins, as we're still seeing, because their cash conversion cycle is still lowering, and that's probably the main reason their cash conversion cycle has skyrocketed. And on here, I won't be able to go back to 2015 or 2014 because it only allows 5 years of data on the financials tab, unless they change something, which actually I'm double check now. Yeah, it's still only 5 years, so we can't go back on the balance sheet. But, and I'll get to my own valuations here in a second. So what I saw then was essentially a company that was saying they wanted to be great, essentially saying the same things that GE was at the time. They had a massive increase in their profitability margins pretty much across the board in 1 year. Again, that's not consistent. So what did I see specifically in the financials and my analysis that led me to buy this stock? And why I'm not surprised that it's now a 10 bagger plus. Okay, picks and shovels. I'll give an explanation here. Okay. When I bought, it was $640 million. It's now $7.2 billion. It's undervalued by as much as 40%. Pay us a 10% dividend. I think it was paying special dividends back then, if memory serves me, which we'll probably see in a second. But here is one of my analysis pieces, my competitive analysis that I was doing. This is another huge reason that I loved BESIY. Here, comparing it to other companies in its industry, I found that BESIY pretty much across the board was either number one, either the best by far in terms of things like operating profits and margins, or it was second in most of them. This, when you do a competitive analysis like this, if you do a competitive analysis like this, that pretty much never happens. And if it does, the company's margins may be like 6, 7, 8%. They're not above the thresholds I look for. So again, operating margin, trailing 12 month, 19.7, 5-year operating margin, 11.8. I look for anything above 10% on a consistent basis. Most times when you do a competitive analysis like this, most companies in most industries do not reach my thresholds of 10% plus operating margins and returns on invested capital and 5% plus free cash flow sales. In most industries, probably I estimate far fewer than 5% of all companies on earth meet those thresholds right there. So if you see a company that meets those thresholds in general, that's good. If you see a company that surpasses those thresholds in an industry that they're growing in, it's a very good sign that the company, again, if they can keep things up, is potentially a great stock, combined with the valuation up here, TEV to EBIT. This is total enterprise value to EBIT. Total enterprise value is different than enterprise value. And that, I think I have a video on that I'll probably put in the description because that's a whole another topic. But compared to its competitors, it had huge margins. And again, huge margins, meaning not only above industry average, but above kind of my thresholds as well. If you do a competitive analysis like this, and you see a company that has margins that are not only larger than what you look for, but also larger than the industry average, as BESI-wise was, it's a great sign the company has competitive advantages. Why? Because in general, if a company, or let's say there's 10 companies in the industry, they should all have very similar margins based on their economics, based on the competitive strengths and disadvantages of the industry. Some industries are more profitable than others, some are worse than others. But in general, every company in the industry should have pretty similar margins, unless they have either a competitive disadvantage, which means they would have lower margins, or they have a competitive advantage. What are some examples of competitive disadvantages? Maybe their operations aren't very efficient. Maybe their supply chain isn't very efficient. Maybe they are spending too much money. Maybe they aren't allocating capital well. Those are some things that might put a company at a competitive disadvantage, and that will again mean lower margins. What are some examples of a competitive advantage now? The opposites of the things I just said. They're more efficient. They have better processes. They have better systems. They have better operations. They spend less money as a percentage of sales. All those kind of things. How does that happen, though? In this case, memory serves me right, and we'll probably get to that in a second. I think they had some patents, and if they didn't have patents, again, I can't remember. This was 6+ years ago now. Then they had processes that they were very good at. And I remember specifically, I think it was systems or processes that they had built out. Maybe that combined with some patents and stuff as well that gave them a competitive advantage, that gave them these higher than industry average margins. That has continued to this day, obviously, with their margins being gigantic, still actually growing still. So their competitive advantages may have actually increased since then. But that's a story for a different day. So for the valuations, so it has great margins, above industry average margins, competitive advantages, in my opinion. This is what I'm seeing. That plus, it was massively undervalued on relative valuation metrics. Right here, I look for anything below 8 for EV to EBIT, TEV to EBIT, TEV to owner's earnings, which is 2.9 right here. TEV to free cash flow, this is 6.39. I look for anything below 8 on all those metrics. So averaging those together, those average 5.13. That means the company is enormously undervalued. And combined with that, it had competitive advantages and gigantic margins and a lot of cash, little debt. These, back then, again, these were signs to me that I needed to buy the company in portfolios I manage, because it's a great stock. It's a great stock that was undervalued. Warren Buffett has a saying, I'd rather buy a fantastic company at a fair price than an okay company at a great price, something like that. I probably butchered that, but excuse me. But why not have both? Why not have a great stock at a great price? Yes, it's extremely rare to find that, but when you can, it can lead to huge returns. Again, here we get into the BESY Semiconductor stuff, their operations. These are some of their, so this was another reason I love them, is because they work with companies like Samsung, Micron, Toshiba, Bosch. They even worked with, you'll see here, SPIL. We scroll back up. That's one of their competitors, one of their bigger competitors. Actually, they were far smaller. Now we'll see. I'll go and check here in a second if they're bigger or smaller. But what that means is if a company's far bigger competitors work with it, that must also mean that that's also a sign that they have competitive advantages, because why else would a company that's far bigger work with a far smaller company unless they had some specific niche advantage that they didn't have? In the defense contracting space, it's called a subcontractor. It's more common there. But in this kind of arena, and again, subcontractors here, it's not, I'm not going to say it's not uncommon, because it is, but it's still, when I saw this, I remember thinking, its far bigger competitor is working with this company. It wouldn't do so unless, again, it had some kind of advantage or some kind of process or some kind of equipment that it does not. Actually, before I forget, let's bring up Morningstar again to see what. Oh, and here's a picture of its stock chart while we're here. So I was looking at it in October, around October 20th. And this does not include dividends. The other number included dividends, and I can show you that chart here in a second. But it's up from about $7.50 a share to $92.75 a share. SPIL. They are not even a company anymore, at least a public company. That's interesting. What was the name of the company? Let's go back over here. So they are no longer a public company. I don't know. That means they got bought out. That means they got Silicon, where this is in Industries. Okay, so they got bought out by ASE. Okay. So that's interesting. I'm actually surprised BESIY didn't get bought out, because again, they were far better back then. Yeah, surprising to me. But they got bought out for, what was the valuation? So 25%. So they got bought out for just under $4 billion. Again, that company could have bought BESIY for cheaper than the entire company, for cheaper than, but that's their loss. Okay, so here we go. Cost, where screen am I on, by the way? Showing you on the screen. Let's get you back over to the other screen. There we go. Okay, so here's where I get into some of the advantages that I saw. The power reducing costs. Costs are about even for everyone unless you have a special process, patent, or can cut costs. BESIY does all three. But in the last few years, it has concentrated on cutting costs and becoming more efficient. This is the reason their margins are not only higher than competitors then, but also why they rose so much in a short amount of time. It cuts costs by improving and standardizing its packaging processes and products and moving operations to Asia from Europe. And you see what that's done from from there to increase their margins, and that's continued. And I said, even this is incredible. I don't get hyperbolic and that kind of stuff. Margins rise a lot in a short time period. It means the company's becoming more efficient, and more efficient company means value within the company compounds. And in time, this will lead to a rise in share price. That was a massive understatement. Again, it's up 1,200%, including dividends, since I recommend it to shareholders. But again, if you see a company that's actually doing that, increasing their margins, this is another sign of a potentially good stock to look at. And this is why, which I'll explain later, margins that rise a lot in a short time also mean the company doesn't have to issue debt or shares to grow internal business. This means the company The company is producing excess cash it can use to increase shareholder returns. And I'll explain more of that later. Profitable every year from 2009, increasing so in the 5 years leading up to the time I bought, its average operating margin was 11.8%, and it was at a high of 19.7% in the trailing 12-month period. It's doubled. It's up to 40% now, which again is absurd. Okay, here's where I get into some of the relative valuations. Anything else I'm going to talk about in here? So I won't bore you to death with things like owner's earnings and total enterprise value. This is what another thing I want to talk about. Owner's earnings. I want to explain owner's earnings today. We talked about this in our masterclass, but this is a way to gain a huge advantage over other investors. What you can see here is essentially what the true quote-unquote earnings a company earns in any given year or any given time period. Most of the time, this is higher, 207 million versus net income of 74 million. So you can find a company that is far more profitable in a real world sense, an economic sense, than what shows up on net income. If you can do that with this calculation, again, it's a long, confusing calculation that goes far outside the scope of this video. That is another way to find potentially undervalued assets and stocks. That isn't all. BESIY also had net operating loss carryforwards, significant amount of those. A hidden asset I talked about in a recent video on, what was that? I'll try to find it. It was one of the recent stock analysis videos I did. I found, I think it was, no, it was for WidePoint. It was WidePoint part 3 or 4. If you can find net operating loss carryforwards, again, I'm not going to go into full explanation here. If you want it, go to those videos, and I'll link those below this. Okay, so I just took a note of those WidePoint videos. I'm going to put in the description so you can get the full explanation here. But essentially what this means is the company may not have to pay taxes for 1 year, 5 years, 10 years, however much profit it's earning. This can increase, obviously, the company's returns because then it doesn't have to pay taxes. And again, for the full explanation, go to that. But that's another hidden advantage you can get from reading a company's financial statements, specifically the 10K, the annual report in this case, or the 20F since this is a foreign company. I did my own ROIC calculation, and it showed up to be even higher than the one on Morningstar. The reason I do my own calculation is because I don't know what goes into the ROIC calculation on Morningstar, and there are different ways to calculate ROIC, but the way I calculate it is here. And that's the way I've done it for years. And I've done it this way for years, A, because it makes the most sense to me, but also so I can compare this to other companies as well on an apples to apples basis. Okay. Cash flow sales, return on tangible equity, and ROCE. ROCE, these are metrics I use from Buffett to also measure profitability. Same thing here. Like for anything about 10% on a consistent basis, the other was like 22%, 22.2%, and this one is 45.8. This is one of the highest numbers I've ever seen on this unlevered return on intangible equity number. Higher that number is, the better. Again, all these show that the company has had either competitive advantages or potential competitive advantages. Because again, when you have higher than average operating margins or profitability margins for a long period of time, it's a sign you do have competitive advantages, because over time with competition and innovation and technology, you should have very similar profitability margins to competitors unless you have competitive advantages. It also buys back stock, pays a dividend. Again, more good things in my book. Insider ownership, insiders and funds own 38%. Two small cap investment companies own stock in it. These aren't huge deals, but it's always good to see kind of insider ownership higher, and funds, especially value or small cap funds, owning stock. Okay, so here's where I get to the valuations. Valuations, it was enormously undervalued. Again, I'm not going to go through this today because we know it's undervalued now because it's up huge. Okay, here's a big one. Since 2010, it's increased its market share from 10% to 31% in 2014. The company projects this will continue to rise. This is a huge thing. Market share is a huge thing, especially in an industry like picks and shovels where it's necessary. If a company owns a huge amount of the market when its products are necessary, that company is pretty much guaranteed to continue to grow. And not only continue to grow, but can probably raise prices as well, which gives the company pricing power, competitive advantage. Here's what I say about this. Because of these things, BESIY should be able to keep up this year's numbers and maybe continue to improve them. If this happens, BESIY shares could explode and could turn BESIY into the next GE. Now, it's still not the next GE as of this recording, but again, it's up 1,200% since I made these statements and did this analysis. And again, I get into the Internet of Things here, blah, 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 blah. And then, of course, there are always risks. And for this one, it was their margins rising huge in a short amount of time. Their margins might go back down. Internet of Things might stop or might slow down, might not stop, but all these things. So these, oh, and it's only had at that time $18 million in debt compared to a huge amount of cash. What else? Anything here? And then here's the buy recommendation that I put out at that time. And then also a note. As I was getting ready to release this, the stock went above the recommended buy up to price. This was my price target. I had a $20 buy up to price on it. So we had to wait a little bit to buy. Luckily, it came down and we were able to buy in the portfolios I manage. Okay, so we covered a lot of ground in the last 30 or so minutes. If I didn't explain something well enough, let me know in the comments below. If I should have explained something better, let me know in the comments below. But the whole idea of this video was to show you traits that I saw back in 2015 that has led to this company being up 1,200% since I recommended it in this newsletter to subscribers and bought it in the portfolios I manage. And I'm bringing up the stock right now with the actual returns that include the dividends, so you can see the full number. And where is my screen now? Bring my other screen over here for a second. Okay, so here we go. BESIY, again, same date, including dividends. It's up 57.1% on average per year for a total of almost 1,300%. Again, I'm not saying, absolutely not saying, looking for these things like competitive advantages, huge margins compared to the competitors, a huge trend behind it, hugely undervalued, a lot of cash, no debt. I'm not saying these things will lead to you finding a 10-bagger stock. However, I will say with 100% confidence and 100% certainty that these things will drastically, if you look for these things and you find them, they will drastically increase your odds of success in investing. This is why I show that in the stock analysis I do on a regular basis. This is why I show these things. Because again, if you can find them, we haven't found them very much in those stock videos, or the new stock videos, analysis videos, because frankly everything's overvalued right now. But if you can find the combination of huge operating profits, huge ROICs, huge free cash flow to sales, huge trend, huge undervaluation, fantastic balance sheet strength, competitive advantages, if you can find this combination of things, you drastically increase your odds of success as an investor, and you will drastically increase your returns. Now, some of these hidden assets I found, specifically the NOLs, the analyzing the competitive advantages and finding those competitive advantages, the competitive analysis. I haven't talked about those. I talked about the NOLs. The other things I haven't talked about in those stock analysis, other stock analysis videos I do on YouTube. Why? Frankly, because they haven't come up yet. I haven't found a stock that where they've come up yet, other than the NOLs, which was came up in the last wide point video. If you want to learn more about how to become a better investor faster, how to spot these things, how to look for them, where to look for them on the annual reports, make sure to check out our newly relaunched masterclass. You'll learn all of this and much more in that masterclass. Ton of videos, a ton of resources. I go through 23 different valuations. Everything you'd want to learn to become a great value investor is in that program already. We're working to redo the videos, to update them. When I first recorded the videos, I didn't have an HD camera like I do now, so we're going to update it for that quality as well. But we're also doing live trainings, group trainings, probably some one-on-one trainings for the first people that sign up. And we're already getting people signing up. If you want that more kind of hands-on knowledge on how to spot these kind of things specifically before the next market crash happens, because you want to know these things before the next market crash happens so you don't have to learn it kind of on the fly, make sure to check out the link to our masterclass, our newly relaunched masterclass below. If you have a stock like this, or if you find a stock like this with these processes, I'd love to hear your thoughts. I'd love to hear your wins. I'd love to hear your wins if you find a stock that goes up 50%, 100%, 500%, 1,200%, 10,000%. If you use these processes, even if it's just these free videos, and you don't ever join the masterclass, don't ever join our coaching program or anything we release in the future, let me know. I want to know. Sorry about that. That was my dog. I want to know your wins. Sorry again. My dogs, two of my dogs are older and they have doggy COPD, so I apologize for that obnoxious noise. But I want to hear your wins. I want to hear your success. I want to hear your questions. I want to hear how it can help you improve. Again, even if it's just with these free videos. If you want more specific help, make sure to join the masterclass. But if it's even from these free videos, this is why I do them. I want to help as many people as possible with these kind of things. And I hope this case study video has helped on my first official 10-bagger. Why I say official is because some other companies that probably would have been 10-baggers by now, they got bought out, they got merged, they went private, stuff like that. But this is my first official 10-bagger, and I want to share these successes with you to teach you so you can look for some of these same tips, some of the same traits in stocks you're looking at to help you find maybe your next 10-bagger, maybe your next 100% riser, maybe just drastically, at the very minimum, drastically increase your odds of success in investing. I hope this has helped. If you want me to do more videos like this, let me know, because I have not necessarily the 10-baggers, but I have other stock case study videos I can do on stocks I own. And I hope you enjoyed this video because I've never released... She's killing me. I've never released the name of any of the stocks I've bought publicly unless they were subscribers of this newsletter. The reason I do that is frankly because it's essentially proprietary information. I wanted to share this with you again to help educate you, though, to celebrate with you my success in the portfolios I manage by teaching you, and so you can hope find the same things. But I hope you found learned a ton in this video. We went through things kind of fast, so if you need to, make sure to rewatch this video a couple times. Leave it as notes. Feel free to take anything in the video that you see in terms of the analysis, or you can get a lot of free resources. A lot of these resources you see in here are for students only, but there are some free resources you can get as well in the links below. But until next time, have a great day. Talk soon.